Hi everyone, welcome back to the channel. This is Rosario Borgesi, and in this video I want to talk about the most famous decentralized exchange on Ethereum, which is Uniswap. So let's get started. So these are the topics that we will cover in this video. So the difference between a checks and a DEX. We will talk about Uniswap V2. We will talk about what liquidity providers, what is the arbitrage, um, we will talk about Uniswap V3, Uniswap V4, and also in the end we will make an hands-on demo. We will show how to make a swap and provide liquidity in Uniswap V2, V3, and V4. So, le- um, the first thing to talk about is that in the crypto world we have, as you can see here, a bunch of tokens, BTC, ETH, whatever. This is Binance, so HX, and we need a way to swap tokens. So to swap tokens, we basically have two ways to do it in crypto. One is to use a centralized exchange, a classical exchange, checks. Another, it is to use a DEX, so a decentralized exchange. So at first glance, the first thing that we can say is that a checks like Binance allow us to swap tokens that are on any chain, while a DEX, classical DEX on Ethereum, like Uniswap, allow only to swap tokens that are listed on Ethereum or in the Ethereum layer 2. So, for example, it is not possible to make a swap between on Uniswap. It is not possible to make a swap between Bitcoin and Ethereum, for example, but you can only swap a token that is present on Ethereum, and it must be an ERC20. While on Binance, HX, you can swap, for example, BTC for Ethereum, for BNB, for Solana, whatever. But let's dive more into these two um, these two types of platforms. So the basic difference between HX and the DEX is that HX is based on an order book, and we have a seller. So someone who wants to sell something, a token in this case, for example, Bitcoin, and another, a buyer who wants to buy Bitcoin. So how do we match the seller and the buyer? We match them by using an order book. In this case, instead, in a DEX, we have an LP, which is a liquidity provider, so someone who is providing liquidity, providing tokens, and we have a trader, so someone who wants to swap, for example, a token for another, and we will use a DEX, which is based on an AMM, so an automated market maker, and it is totally decentralized. So let's start by talking about a centralized exchange, so HX. A centralized exchange, so it is a platform that allows user to basically trade tokens by matching buyers and sellers through an order book. So the key points are that it holds the user funds, uses of course an order book, matches buyers and sellers, and acts as an intermediary. Okay, so this word intermediary in Web3, in the crypto world, is not really the best word. And examples of centralized exchange are, for example, Coinbase, Binance, BitGet, or Bybit. But there are, of course, a lot more. So what is an order book? As you can see here, we have the we are the buy orders and sell orders. This is for the couple it USDC. This is taken from Binance. Okay, so buying orders and sell orders. So of course, um, here the selling orders are increasing while the buying orders are decreasing. This is of course because I want to buy at the lowest price and another person wants to sell at the highest price. When there is a match between one order and another, the exchange happens. So okay, here there is an example of trade. For example, Alice wants to buy one ETH at 2000, Bob wants to sell one ETH at 2000. In the order book, there is a buy orders, a bid. So Alice wants to buy one ETH at 2000 and a sell order and ask. So Bob wants to sell an ETH at 2000. So what the exchange does not do, the exchange does not buy it from Bob, the exchange does not sell it to Alice, the exchange does not use its own money, but the exchange, what does, it only matches Bob's and Alice's orders and earns a fee. So simple as that. The exchange does not put its own money at risk, but it simply matches a person that wants to buy and a person that wants to sell. So what are the limitations of HX, open a centralized exchange, custodial risk, single point of failure, of course, order books require market makers, server downtime possible, censorship and account freezing, and KYC requirements. Of course, these are all things that, as you can see, the blockchain wants to overcome. On the other hand, we have a decentralized exchange. A decentralized exchange allows user to trade tokens ERC20, which is a standard that allows to create, let's say, tokens with similar properties and to exchange them. So it allows user to trade tokens directly from their wallet without relying on a centralized intermediary. So, of course, what makes it different, it's non-custodial. So, while the exchange holds your funds and anytime can say, okay, you are not allowed to get your money back. For example, as happened to FTX, in this case, it is non-custodial because it is governed by smart contract. So you control your funds. The funds are in your wallet, and of course, the smart contract is the one that performs the trade. No one can stop it. The smart contract works 24 hours each day. There is no order book. So it works differently, as we will see. You have to trust no one except the code in the smart contract, and it's permissionless. So for example, in a bank, not anyone can open an account, but here anyone can use a decentralized exchange. And of course, it requires no KYC because it is handled by smart contract. There is no intermediary, so no KYC is required. How it works, trades happens on chain. The users are the one that provide the liquidity. If a trader wants to make a swap, he has to trade against the liquidity pool, because the liquidity pool holds the token that are put there by the liquidity providers. Anyone can provide the liquidity. Of course, it will earn fee, as we will see later. Prices are set by math, so by automated market makers and not by people. Anyone can list a token. There are no restrictions, and of course, the protocol is always available. So let's start talking about Uniswap V2. let's imagine that we have a pool. So the pool is a smart contract basically that holds the token. The pools are 50, let's say 50% Ethereum and 50% USDC. So, for example, if you put in the reserves 1000 ETH, you have to, the pool must also have 300,000 USDT in this case. For a pool, of course, ETH to USDC. If we have another pool with other two tokens, for example, ETH DAI, it will have 300,000 of DAI. Of course, the 50-50 means the price. So the price must be equal the total price of one token and of another. As we can see here, there are also the liquidity share, which are other tokens that are provided to the person that deposits, that provides liquidity. In fact, we have a liquidity provider that, for example, wants to deposit 1 ETH and 3000 USDT and gets a liquidity provider share. Why it gets one liquidity LP share? Because of course this is 1% of the pool, of the entire pool. Okay, and this, of course, this token that the liquidity provider gets, so it basically gives to the pool smart contract this two amount of token and gets this token here, because this is a way for Uniswap to let's say remember that you deposited these tokens, and also it accounts for the fee that are accrued with each swap. On the other side, we have a trader. So the trader, for example, wants to swap one Ethereum for let's say 3000 USDC. It will provide one ETH and it will pay 0.3% of fee. This, of course, on Uniswap V2, on Uniswap V3, the fee tiers are different, and it will get in output 3000 USDT from the pool. Sorry, here it should be USDT, but it is the same. USDC and the USDT are both stable coin pegged to the dollar, so they both should be worth anytime $1. So it is a similar. They are similar. So here there is no one. There is no magic money. Let's say there are some people that deposit money. The smart contract holds the money and provides this liquidity to the trader. So all this stuff is done through smart contracts. So let's talk about liquidity providers and LP tokens. So let's say that a pool before deposit has the previous example. This example here has 100 ETH and 300,000 USDC. So the total liquidity is represented by 100 LP tokens. One LP tokens represents a share of the pool. So if you hold one LP token, you hold 1% of the pool. A user, let's say that a user provides liquidity, so it provides 1 ETH and 3000 USDC. It cannot provide just 1 ETH or just 3000 USDC. It has to provide both, because the pool is 50% ETH, 50% USDC. So it is providing 1% of the pool liquidity. So it happens that LP tokens are minted. So the protocol means one LP token to the user. The total LP supply becomes 101 LP tokens, and the user owns 1 over 101 LP tokens, so more or less 1% of the pool. So an LP token represents a percentage share of the pool and a claim on, of course, the ETH reserves that you have deposited, the USDC reserves that you have deposited, and of course, this allows you to earn the trading fee that are accrued and calculated on your LP tokens. Let's talk about the automated market maker. So an automated market maker is a system of smart contract that allow users to basically trade tokens automatically using, as we have seen, liquidity pools and mathematical formulas. So this is the change that we have with respect to an order book, and we will see this more in detail later on. So the AMM adjusts the prices automatically based on supply and demand. The core components of the AMM are of course, the liquidity pool, the smart contract that holds the true reserves of tokens that are ETH and USDC, and the pricing formula, which determines the price based on pool balance. For example, in Uniswap V2, the product of the true balance of the token must be constant. So this is the price formula. Now we will understand better. So the IMM formula is that ETH, for example, for a pool ETH USDC, the ETH balance in the pool times the USDC balance in the pool must stay constant anytime. So as we can see, the price can, let's say, change in this curve here. So let's make an example. So let's imagine that we have an ETH price of $3,000. The pool reserves are 100 ETH and 300,000 USDC. So the K that must be constant is 30 million. Okay, let's imagine a case where we want to make a small trade. So we want to make a swap of 0.5 ETH to USDC. So what happens in the pool? So when I want to swap 0.5 ETH, in this case, there is no order book. So there is not another person that wants to sell me 0.5, sorry, that wants to give me 0.5 worth of USDC. Sorry, zero, of course, 0.5 times the price of Ethereum in USDC. But what happens in the pool is that when I want to make this swap, the first thing that we do, we are depositing this ETH into the pool. So the ETH increases, the ETH in the pool, ETH balance increases from 100 to 100.5, and the USDC must decrease so that the product of the two balance is constant. So this means that we have a new USDC reserve that it is calculated from the K that we have calculated before divided by this new value of it. This is the amount of USDC that will stay in the pool. And this means that the user that is making the trade, that is giving the 0.5 ETH, will get in return this amount of USDC, 100, sorry, 1,400 USDC, more or less. This is why there were 300,000 USDC before in the pool at the start here, and so we have the pool must be constant. So this is the amount that of USDC that must be in the pool. So in the end, the excess must be sent to the user that is making the swap. So the trade price in this case can be calculated as the ratio between USDC and the USDC that you get from the trade, and the it that you have provided in the swap, and is the price of it, the actual price at which you have performed the trade. So we have made the trade. We wanted to make the trade at $3,000, but we actually made the trade at less than $3,000. So we have to talk about the difference between the spot price and the trade price. So the spot price is the price of a token before a trade happens, so $3,000 in our case. The trade price is the average price actually paid for the trade. So in our case, it is 2,900 and something for this trade, and the slippage is the percentage between the spot price and the trade price. So in this case, we had a slippage of 0.5% more or less, because we expected 3,000, we paid this amount here, and so we have obtained less um, less USDC than the ones that we were expecting. So here it has been the calculation has been made more clear. So spot price $3,000, trade price 2,900, and so on, and the slippage here 0.5%. So small trades have a low price impact. Let's talk about the larger trade. So if for example we want to swap 10 ETH for USDC, in this case the pool increases of it from 100 to 110. So the new USDC reserve will be the same calculation we did before. This amount here to 270,000 USDC. And so the user gets in the end 27,000 USDC. So the trade price in the end was $2,700 dollars. So it is even worse than the trade we did before. So the price impact in this case will be this one. So the spot price always $3,000, trade price $200,700. The slippage is 10%, so it is higher, because before the slippage was 0.5%. So we can say that large trades cause higher price impact, and of course order book based exchange, so for example Binance, Coinbase and so on, are more often more efficient for large trades than of course a decentralized exchange. Now when we deposit a token, as we have seen earlier, into the pool, so for example, we want to make a swap of Ethereum for another token like USDC, there is, of course, the price after the swap changes. The price of Ethereum in the pool changes with respect to, for example, another exchange. So there is an opportunity for arbitrage. So let's say, for example, that after a big trade, the AMM price has changed a lot from other exchange. For example, in this case, Uniswap it price is $2,900, while the price of it in other exchanges like Binance, Coinbase, whatever, it is $3,000. There are bots that act on this price difference between these two platforms, and they make a trade so that they earn, of course, money from this difference, and so they They make it so that in the end, Uniswap will have the same price of the other exchange. So they put them into balance. In this case, as we said before, there is an arbitrage opportunity. So an arbitrager can buy it on Uniswap at the price $2,900, can sell it on another exchange at 3,000 and keep the difference minus the fee. And what happens in the pool? It is removed from the AMM pool, USDC is added to the pool, the AMM price moves up. So arbitrage aligns AMM prices with the broader market. Let's talk about the V2 fee tiers. In V2 there is just a single fee tiers, so 0.3%, and fees are automatically added to the pool. So the LP value, the token that you get by providing liquidity to the pool increases over time via fee. And also the value of the pool increases over time. So removing liquidity withdraws the pool token, so the LP token, plus the earned fee. Okay, so the token, the LP token that you get when you provide liquidity, when you when you withdraw the liquidity, that you will get more LP tokens because it will also account for the earned fee. Let's talk about the difference between fee percentage and the return that we get as liquidity provider. So that 0.3% is not our return. That 0.3% is the fee paid by traders per swap, so not what we earn. For example, if a trader swaps $10,000 and there is a fee tier of 0.3%, the total fee collected is $30. That $30 is distributed among all liquidity providers, according, of course, to the share that they have in the pool, and we only receive a fraction of that $30. So our earnings depend on the trading volume, the fee tier, and the share that we have in the pool liquidity. This is important. Now let's talk about another important concept related to the AMMs, which is the impermanent loss. Impermanent loss is the difference in value between providing liquidity to an automated market maker and simply holding the same tokens. So when the relative price of the tokens changes, because as we have seen, if, for example, Ethereum has a price of initial price in the pool of $3,000, we provide the liquidity, we provide one ETH at $3,000, the total value will be $6,000. What happens instead if the ETH price increases to 4,000? What happens in the pool? It will happen that traders will buy it from the pool, so it will go down in the pool and USDC will increase. So our LP position is automatically rebalanced. When we withdraw the liquidity, we will have less ETH and we will have more USDC. So the total value is lower than simply holding the tokens. And this difference is called impermanent loss. So this is important to keep in mind, that when we provide liquidity, we risk to, of course, lose value of our tokens. But of course, we will gain from the fee that are collected from the swaps. So this is a thing that we should keep in mind. So what is impermanent? Impermanent means it exists only while the liquidity it is provided. If the price returns to the initial ratio, of course it disappears. It becomes permanent only when we withdraw. What about fees? So the fees are we have talked earlier. So the trading fees are paid to the liquidity providers, and of course the fees can offset or exceed the impermanent loss, because of course if we provide a lot of liquidity and the liquidity stays for a long of time, it can of course exceed the impermanent loss. So, being a liquidity provider is a trade-off of fees versus price risk. Okay, so now let's talk about Uniswap V3. Uniswap V3 is third version of Uniswap, and let's see what it has been changed in the in the new protocol. So the main difference between Uniswap V2 and V3 are in this table here. So first of all, the liquidity distribution. In V2, the liquidity is spread across all prices, 50-50. In V3, there is the concept of concentrated liquidity, so liquidity concentrated inside specific price ranges, as we will see later. Of course, capital efficiency in V2 is low because most liquidity is unused. In V3, much higher capital efficiency, because if I concentrate the liquidity in a specific range, more of my liquidity is used, I can earn more fees. Because of course I only earn fees when my liquidity is near the price of the token. LP position, this is a technical difference. So in this case, they use LP tokens, RC20. In this case, non-fungible LP tokens and NFTs. This is important. Fee tiers. In Uniswap V2, we have a single fixed fee, 0.3%. Here in V3, we have multiple fee tiers. So we have 0.01%, 0.05%, 0.3%, 1%. Fee allocation. So the fees are auto added to the pool, while in this case the fees are accrued separately from the pool. The slippage higher for the same TVL. In this case, lower slippage near active price ranges. LP control, here there is passive LP, here there are custom ranges, LP strategies by using the range plus the fee of choice. So let's talk about this new concept of concentrated liquidity that has been introduced in Uniswap V3. So what changed with respect to Uniswap V2? In Uniswap V3, this concept of concentrated liquidity allows liquidity providers to allocate the capital within specific price ranges. So the liquidity is no longer spread across all prices. It is concentrated around the current market price. More liquidity, we can have more liquidity at work, so at active prices, and liquidity providers can earn more fees, of course. Deeper liquidity when trading actually happens. Let's talk about the difference between full range and custom range. So, if we are selecting full range on V3, let's say that the price of Ethereum it is $3,600. The full range is like Uniswap V2, so it is from zero, the minimum price to the maximum price, which is infinite. So it is the same as Uniswap V2. We are not concentrating liquidity. In this case, we are choosing a range, for example, here between 306,000 to 380,000. If the price of Ethereum is here, we earn from the fee. If it goes outside, we don't earn from it anymore. So in the case of full range, the liquidity is provided across the entire price range. The liquidity is always active. You always earn a fee, and it is of course when trades happen, and it is similar to Uniswap V2. In the case of custom range, the liquidity is provided only within a chosen price range, liquidity is active only inside the range, you earn more fee. Let's talk about the price out of range. When the price is in range, the liquidity is active, trades use your liquidity, you earn trading fee, you hold both tokens WET plus USDC. If the price goes out of range, only, for example, if it goes above range, like in this case, all liquidity is converted to USDC. We hold the less performing token. We hold 100% of USDC. The liquidity becomes inactive. No more fee earned. If the price goes below the range, like here, all liquidity is converted to wrapped Ether. We hold 100% of wrapped Ether. Liquidity becomes inactive. No more fees earned. Price out of range does not mean that we are losing funds. It means that our liquidity is no longer used for trading. So what can do liquidity providers? Can wait for the price to return into the range, can rebalance by choosing a new range, or can remove the liquidity and exit. Let's talk about liquidity tiers. In Uniswap V3, we have 4 types of tiers: 1%, 0.3%, 0.05%, and 0.01%. Fees are accrued separately from the liquidity pool. Liquidity providers can collect fees anytime without removing liquidity, and collected fees can be kept in the wallet or reinvested into the position. Okay, so how V3 fees work? Example, a trader wants to swap $10,000. The fee tiers are 0.3%. The total fee collected is $30. So the key difference with the Uniswap V2 is that $30 is not split among all liquidity providers. It is split only among liquidity providers whose liquidity is active at the current price. And so, if the total active liquidity at that price is, let's say, $1,000, our liquidity in the range is 50,000, our share will be 5%, and our earnings will be $1.5. So the 5% of $30. So in Uniswap V2, the liquidity is always active. Fees are split among all LPs. The earnings depend on trading volume, of course 0.3% fee, the share of the total pool liquidity. In Uniswap V3, the liquidity is only active inside the price range. Fees are split among active LPs only. Earning depends on trading volume, fee tier, our share of active liquidity, and the time spent in the range. So, as a general rule, the fees are earned only at the current price, while the ranges dilute liquidity and reduce fee share. Let's talk about Uniswap V4. So let's start as previously with the difference between Uniswap V4 and Uniswap V3. In Uniswap V4 there are mainly some changes from the point of the smart contract. In fact, as you can see here, the pool architecture is changed. In V3 there was one contract per pool. In this case, there is a singleton contract for all pools. The custom logic was not possible in V3, while in V4 had been introduced the hooks, which is a custom code that can be executed before and after swaps and liquidity. The fee tiers were presets were fixed, so 0.01 up to 1%. Here you can have custom and dynamic fees via hooks. fee behavior is static. Here you can have dynamic and programmable fee logic. The AMM design is the fixed AMM model. Here there is a programmable AMM. In this case you can this could only handle wet. So ERC20 token. Here there is support for native it. And of course, gas efficiency, higher deployment costs, here lower gas via singleton design. So in V4 pools can have hooks. Hooks are smart contracts that run before after the swaps, before after liquidity changes, before after fee collection. This means that pools can now have custom behavior. Examples: dynamic fees, time-based liquidity rules, automated rebalancing. So let's talk about the V4 fee tiers. There are unlimited fee tiers. Fees are accrued separately from liquidity. LPs can collect fees anytime without removing liquidity. Fees can be kept or reinvested. Removing liquidity withdraws liquidity plus fees. Let's go to the demo. So this is the Uniswap web page. Let's try to make a simple swap. So the first thing to do is to connect the wallet as always. Okay, this is my wallet that has $10 of it. Connect. Okay, so now it is my wallet. I want to swap, let's say 50% of it for USDC. So here I can select the chain, in this case Base. So I pay less fee because my tokens are on Base. This is Base Ethereum. Select. I put here, for example, 50%, so $5 worth of it, and I want to swap to USDC. Okay, so it will give me $5 of USDC. Here I can select the slippage. Remember that the slippage is the difference in the percentage slippage, in percentage the difference between the trade price we expect and the trade price at which the trade is performed. Here there is also a swap deadline, and here there are also some trade options. I will leave it this auto. So let's go and do this this trade. So I will receive this amount of USDC more or less. Let's swap this. Okay, now we can see the transaction in our wallet. It is calling execute. This is the input, item 1, item 2. Okay, we can review the parameters. Let's confirm this. Okay, the transaction has been executed. Let's close the extension. So if we go to the wallet, we can see here that we have received $5 of USDC. But this is buying at a market price. Another thing that we can do, we can buy with a limit order. For example, we can say I want to buy in this case it. Okay, when Ether is worth, let's say, 10% less, I want to pay in USDC dollar, so I will buy this amount of it. Now we can do this because it is only supported on mainnet, but this is an example of buying with a limit order. So I say I want to buy, for example, when the price is 10% less. Okay, instead in the previous case we have bought at the market price. Another thing that you can do here, Uniswap allows you to do the on ramp. which means taking money from fiat to the blockchain, so buying crypto essentially, and it allows you to do it by using a third party service. For example, if I want to buy $5 of it on the mainnet in this case, and I hit continue, um, it brings me to MoonPay, Stripe. These are all Coinbase are all services that allow you uh, to exchange fiat money, dollars or euros, whatever, to buy crypto. And in this case, you can sell your crypto for, let's say, fiat money. In this case, for example, if I put $5 on the maximum, let's say, on it. For example, here I select, I don't have money on the mainnet, I select base, um, I can continue, okay, it brings me to Coinbase. So this can be useful if you want to do on ramp or off ramp. So let's try to act as a liquidity provider. We need to create a new position. In this case, we will always use ETH USDC. So let's try, for example, a V2 position. We want to use base Ethereum. So we are on base. And here we want to use USDC. So our pair, our pool will be ETH USDC. We are in V2. Okay, so it says that the amount earned. Okay, this is the fee tier that for all V2 pools will be 0.3% of the fees. So let's hit continue. Okay, so let's deposit, for example, here the maximum. Okay, he already calculates everything. So for each trade, we will gain. Sorry, the liquidity providers will gain the 0.3%, and depending on our share in the pool, we will gain our part in the fee. So let's provide this liquidity. Okay, let's hit here create. We need to approve in the wallet. Okay, here we are calling the function approve. The spender is a smart contract Uniswap. Okay, this is the value. Confirm. Okay, the transaction has been submitted. Okay, transaction request. Add the liquidity hit. Okay, this is the second transaction. Confirm. Okay. Pause extension. So we have created our position. Okay, here it says we can see the transaction. Let's go to view positions. Okay. So here we can see our position that it is in full range because of course it is V2. This is the APR. And of course our position is always in range because we are in V2. So we our liquidity is always active. So now that we have created our position, I think we can also see it in our portfolio. Okay, here we can see the tokens that are in my wallet. Okay, we can see here Ethereum and USDC. Okay, should be the same amount here. Here we can see the pools. View all pools. Okay, I come back here. Okay, this should have minted an LP token. I think we need to import it here in MetaMask to see it. Okay, it is not it has not been uploaded automatically. So one thing I would do it is to remove the liquidity so we can create another pool in Uniswap V3. So here I do maximum withdrawal amount, withdraw as it, okay, review, confirm, okay, let's approve in the wallet, okay, confirm, second transaction, confirm, okay, liquidity removed. Okay, here this was the transaction we did before, added the liquidity, now we remove the liquidity. Our position, okay, we don't have any position, let's try to refresh. Okay, it's empty. So, of course, now we have held the position for too short time, so here it has not matured any interests, but of course we should gain from the trades that 0.3% of course for our part of the pool for each trade. I wanted to check, okay, here it seems we have still all our money. Let's try to create a new position, this time with Uniswap V3. We can also do V4 because it is similar, since we are not going to use any hook. So we can do, let's say, hit to USDC. Okay, Fee Tier. Here we can choose the Fee Tier. Okay, as you can see here, there is an higher TVL, 1.3 million, and 46% of the users are in this pool, while 2% of the this is a 2% higher, so this means 2% gain for each trade. It has a smaller TVL and it has a low percentage. So basically, this is wants to gain on the volume of the trades, and this is charging uh, uh, an higher fee per trade. So it has a it should have a lower volume, but we can also create our own tire in V3, sorry, in V4, while this was not possible in V3 because in V4 there are the hooks. So let's choose let's choose this one here, 0.05%. Let's hit continue. Okay. Now here we have two possibility. Let's wait a little bit so it loads. Okay, it seems fine. We can be in full range. When we are in full range, it's similar to Uniswap V2. So the price goes between 0 and infinite. So we will always earn some fee. While we can also choose, for example, a custom range. Okay, for some reason is not showing the chart data. Let's try to change here the free tier because we are just showing something. Okay, so full range, as we said, 0 plus infinite. So our liquidity is always working, is always earning something. Instead, if we choose a custom range, we can choose various range. For example, this is for stablecoin. This is the price, okay, of the of Ethereum. So we are really the price right now is 2,500. Let's say dollars per it. So here the minimum price is 2,000 more or less, and here the maximum price is 2,800. So there is a minus 20% here and plus 10% more or less. So basically, if the price of Ethereum is here in this range, we are earning. So here, if it goes out, we will not earn anything. So we can choose here. There are various strategies. For example, here minus 50% plus 10% one-sider. So if we expect that the price will go down, or here if we expect that the price goes up, and of course, for example, we can choose this one. Let's say we can also restrict the range. Okay, so for example, here we will earn more fee because while the price is in this range, we will earn more, while if we use a wider range and the price is not there, let's say we have a less concentrated liquidity, so we will earn less fee. So let's try this just to show how the custom range works. Deposit token, let's say max here. Okay, and let's review this transaction. As we said, this is for Uniswap V3, but is pretty much the same for Uniswap. Uniswap V4, but is pretty much the same for Uniswap V3. What changes that maybe we don't have this 2% here. So, and we cannot create a custom hook. So let's create this transaction. Okay, here we are using a permit 2. Okay, this is a great improvement by Uniswap. Okay, this is the first transaction. Now there is the second one where we actually, let's permit batch. Okay, confirm. So here is saying all the steps. Now we need to confirm this other transaction here. Okay, we are doing multi-call. I expect that this is okay. This is the because until now we have signed the message. We have approved the USDC, signed the message. Now I think we are depositing. Okay, close extension. Okay, confirm transaction, create the position. Okay, here we can review all the details. Okay, let's update here. Okay, so this is a Uniswap V4 pool with 2% fee tier. Okay, so right now we have earned $0 of fee. Of course, this is the expected APR, and this is the price range. So if the price of Ethereum goes outside this price range, we won't earn um, any fee. Maybe we can also make a comparison, I believe, with the Uniswap V3 pair. Okay, as you can no, this is V4. Let's hit V3. As you can see, the fee tier are similar, but of course, here they change because this is the tip well that is locked in this fee tier, and this is how much how many people, the percentage of P or liquidity provider that has chosen this fee tier for this couple here USDC. So you can see that the most used here for V3 it is 0.3% fee. This is the second one, the third one, and so on and so forth. These are very these are not very used. Instead, if we go to V4, this is the most used. 0.05%, then 2%, 0.31%. They are a little bit different, but of course, the main difference here in V4 is that here we can choose, we can create our own fee tier, we can create our hooks. So it is different for this thing here. Here in the section Explore, we can see all the pools that are listed on Uniswap. Here there is the total volume of the Uniswap pool. This is the total TVL, and this is a breakdown for each protocol. This is the V2 TVL, V3 TVL, and V4 TVL. As we can see, in V3 there is an higher TVL than V2 because of concentrated liquidity. Here there is less because it is newer. Here we can see, of course, this is ordered by TVL. We can see that we have the various type of pool, the protocol, V2, V3, and V4, okay, the fee tier, the TVL, of course, the APR, annual percentage rate of the pool. This is the trading volume of the last day, the trading volume of the last 30 days. And this is a capital efficiency metric. Of course, if the 0.01 means that 1% of the liquidity is traded per day, of course, if it is higher, the liquidity is used more. So this is one of the best quick signals for help. So let's explore one of these pools. For example, E2USDT, V3. Okay, here you can see the trade distribution. So you can see, of course, where most of the fees, this is a 1 day graph where most of the fees have been generated during the day. Of course, you can do also during the week, for example. But what's important, of course, it is the 20 hours fee that you can calculate by, since you know that in this case you are a 0.3% fee tier. You can make a very simple calculation. Here, for example, you have a 24-hour volume, so 59 millions. Okay, you do times 0.3 divided by 100. Okay, and this is the fee tier, sorry, the fee earned by this pool during the day. Of course, you can see also the TVL, the pool balances. This is an estimation of the APR. So basically, what's important from the liquidity provider standpoint, it is the volume and also the fee tier, because of course the total fees are trading volume times the fee tier, as we have seen here. So it is not only important the fee tier, but also the volume of the pool. Thanks for watching this video. If you have any suggestions for other videos, or if you have any questions, please drop a comment below, and see you in the next one.